Hey, Daryl. Are you the one who suggested X-ray? Because I was going to do a video today, and that was the last comment, so that's why I did it. I mean, there's no way I can make a video for all the suggestions because there's not enough time in the day. Because every day I get at least one. Some days, 5, 10 comments on do this ticker. I don't mind doing a ticker. Oh, it's Mike. So if it just happens to be the time I'm doing a video and I'm looking for a stock, unless of course there's a stock on my mind, but I'm trying to really focus on small caps, under 10 billion. That's my niche. Even though it doesn't get as many views, actually I'm not getting many views at all anymore. But I used to average like 1,000 views a video, and if I did something like certain tickers, ET gets a lot of views. Energy Transfer, Alibaba gets a lot of views. Like those videos have broken 10,000 views. But the penny stocks, they don't get a lot of views. But I'm not going to get a lot of views no matter what I do, right? So I might as well have fun with it. So Suncor, that's my biggest in terms of views, 27,000. So usually Suncor gets views every time I do a Suncor video. AT&T gets views. Zim gets a lot of views. So I've done those videos. I've probably done 10 Zim videos, 10 AT&T videos. X-ray, well, we know why it got crushed, right? The Byte product was taken off the shelves. And did someone actually have a problem with it? Like, I mean, I was reading about it, but I didn't really get that deep into it. I just know they stopped making it because I think the FDA found a problem with it. But I don't know if there's like something bad happened or due to intense manufacturing costs involved with the product, which might have led to lack of profits, they decided to stop its production. That doesn't sound right. I don't think it's the cost of making a product. From what I gathered, there was something went awry, like people having problems with it, or it wasn't made well. But let me know in the comments. I did read, let's see. So that's kind of why their revenue went down, and also their stock price came down a lot. Let's see. Shares further weakened on news that the company was voluntarily suspending sales of its Byte clear aligners as a precautionary measure as it conducts a review of certain regulatory requirements for the product. We do not believe the current suspension should significantly impact earnings, as Byte is just 5% of sales. Not a small number, but yeah, 5% is not going to kill the company. But if your revenue is only going up like 2, 3, 4, 5%, which it is, then when you take 5% off the top, you're kind of losing money for the year, or your revenue is going down, which it is. The past few years, their revenue has come down. I think they've averaged a negative 1% revenue growth for the past 5 years. I could show you the chart here. So these are all the companies in their industry. The top 20 in an industry. In the medical instruments and supplies industry, they rank 20th in market cap out of the 54 companies, 2.6 billion. and this column is a 5-year annual revenue growth rate. So you can see it's negative 1%. If it wasn't for Byte, I guess it'd be like positive 4%, or I don't know, maybe positive 1%. Yeah, optical dental work may not be the best industry to invest in during a recession or during times where people are tightening their belt. But I think a lot of products, I'm not sure if a lot of products are how cosmetic the products are. I'm saying I think it may a lot of basic products dentists and orthodontists use. Um, and that is an industry that even if you're struggling, you're going to need basic dental work. And if you're in pain, you're going to go to the dentist. Living with tooth pain is just it's just brutal. Let's see what it says about the company. It's a hard stock to say. Dentsply develops, manufactures, and markets dental equipment supported by cloud-enabled solutions, dental products, and healthcare consumable products in urology and enterology. I don't know why it mentions these two industries because it's really focused on dentists and orthodontists. It has 4 segments: connected technology solutions, essential dental solutions, orthodontic and implant solutions, and then acquisition. Well spec. Camera froze. That happens. It freezes for like a second or two, or maybe 5 seconds. Yeah, I don't know when they acquired WellSpec, but it's part of their the connected technology solutions offers imaging equipment, motorized dental handpieces, treatment centers, and other instruments, 3D printers, aesthetic ceramic dentistry offering, and it's probably pretty good margins. It's not; these aren't commodity products; they're not cheap. They offer products for root canal procedures, restorative products, curing light and dental diagnostic systems, ultrasonic scalers and polishers, and dental anesthetics, prophylaxis paste, dental sealants, and impression materials. They were around since 1877. It's a long time. So it seems like a really good value because the stock. Scott, do you think big tech is overvalued? Not, I don't think it's that overvalued. You know, some are a little more than others, but I think they're growing. They're growing with their market caps. It's not like if you look during the dot-com crash, companies that were losing money were valued pretty high. So they're profitable. So I don't think it's a bad value. So individually, I'd have to look at each company, but they're all great companies. I like to look on Wikipedia because it's nice to get a high level of a company. So they started as Sorona Dental Systems in 1887. It's a long time. It's American dental equipment manufacturer and dental consumable products. It has factories in 21 countries. It's funny when you hear about a company like this that's been around well over 100 years, and it's a not too small of a company. Where's the market cap? 2.6 billion. It's a little on the smaller side, but there's so many companies you just don't know about. 15,000 employees, 4 billion of revenue. It's pretty sizable company. I mean, when you compare it to most companies, which are you could walk down your street, and there's a lot of like, small mom and pops businesses, even some small businesses with like 5, 6 locations. I mean, this is massive compared to that, because probably 80% of the companies out there have less than 5 employees. Because there's a lot of companies that have just 1 employee, the owner. Let's see. Dentsply was founded as Dentists Supply Company in New York City, 1889. Lots of companies just don't stay around that long. They go out of business, or the person who started the company dies, and the company just doesn't keep going. So it's pretty amazing that how long some companies have been around. I mean, if you look at a company, even if a company started in 1960, which isn't that long ago, but even if you look at a company like this, or any company that's been around for more than 20 years, it's like a totally different company than when it started. I mean, they were a dentistry type company, so it's not extremely different, but like look at Berkshire Hathaway. That was a textile company. So it's totally different. So companies, it's hard to compare a company over a long time frame, especially one that changes so much. And with technology, like just because they were a dental supply company, the dentistry was totally different. Because with technology, most companies have to evolve to being somewhat of a technology company. I mean, you don't have to be like an Apple, which is a pure play tech company, but you have to be a technology company to some respect. You need computers at your company, or you actually may sell products that are technology based, which they do, because they do have a lot of cloud-based offerings. So great ticker, by the way, XRAY. So my price point is 25. It's at 13. So it seems like it's really undervalued. Simply Wall Street's at 34. $14 analysts at $19. So everybody's saying it's undervalued. $19.90, it started trading under $1. There's a stock split adjusted. I'm sure it started at like $15, like most companies, or like whatever, 12, 13, 18. So they did 4 stock splits. So it's almost like 3 2-for-1s and a 3-for-2. So two 2 times 2 times 2 is 8. Right? 2 to the third power is 8. 8 times, so it's like you have to multiply all the numbers by 12. So it says $1. So that means an IPO at $12 because you have to multiply all these numbers by 12 to adjust for the price at that actual time. So it started a long time ago, and it grew a ton, 45x from $1 to $45 by 2007, and then the Great Recession cut it in half from 44 to 25, and then it had a nice run up to almost 70 in 2018. In 2018, the S&P 500 went down 6% in 2018. A lot of stocks went down that year. So kind of went up and down, up and down. There was the COVID crash right here. But post-COVID, it got back up to its all-time highs. Actually, it hit an all-time high at the end of 2021. So 69 in May 2021. But ever since then, it's just been downhill. It couldn't catch a break. So what's a good entry point? Well, right now, what is it, 15? It's $13 right now. So in 2001, it was 13. So it's back to 2001 levels. Like if you got this stock for $1, right, and you were up 46x, you probably was so happy. Of course, if it came down to 13, you're up 1,300%, which is really good, but it's come down a lot since the peak. You have been collecting dividends, so it's not all that bad. Debt is a little high. Their debt and equity are pretty identical. Let's look at their debt. What the hell? Financial health. So the red is their debt. So currently, debt and equity are around 2 billion. Debt is, you can see debt is pretty flat. I mean, it's up overall, but I mean, it's not up that much. It was 1.4 billion in 2014. Now it's 2 billion. But you can see the equity is all over the place. It was as high as 8 billion, but equity just keeps coming down, which doesn't paint a pretty picture for the company. But the reason equity is lower is because equity is assets minus liabilities. Equity is kind of like the value of the company. So it's how it's retained earnings is the bulk of the equity. And retained earnings is your historical net income minus the dividends you pay out. So if you never paid out a dividend, you can artificially increase your equity, make it look like your equity is really good. But if you're like a REIT and you pay out most of your earnings as dividends, then it may look like your equity is poor. Sometimes companies have negative equity that are doing fine as companies. It's just they pay out so much in dividends. Like you have to, if you're a REIT, pay out 90% or more of your earnings as dividends. So equity doesn't capture the dividends because dividends are reduced from your equity. So you have to consider that when you look at these charts. If they never paid a dividend, this would be really bad, because you're like, wow, they're really unprofitable. 2016, they had 8 billion of equity, and what happened? But they've given away a lot of dividends. But still, even if you give away dividends, you wouldn't want to see your equity decline this much, because they don't give away that much in dividends. Maybe they buy back a lot of stock. That also detracts from your equity. Because remember, treasury stock is a contra equity account. It brings down your equity. Every time you buy back stock, you are decreasing the value of your company, because cash goes down when you buy back stock, because you need cash, you use it to buy back stock, and your equity goes down. But you can artificially increase your equity by diluting shareholders, adding, because when you issue stock, it brings in cash, right? Because you sell the stock in a primary market, and then you receive cash. Of course, when a stock trades in the secondary market, it has no effect on your balance sheet. Of course, if the stock trades in the open market and the stock goes higher and higher, then you could issue stock at that higher level. So that is a benefit to stock prices going up. International growth is key. Yeah, that makes sense. They have a pretty good so this is the fourth quarter. Okay, they just have fourth quarter. Okay, so here's fourth quarter revenue. What is the revenue for fourth quarter? So it's 900 million. Revenue was $1 billion in Q4 2023. It's down to 900 million in Q4 2024. Everything's going down when you compare Q4 23 to Q4 24 because of Byte. Byte took a bite out of their earnings and profits. Because you see right here, here's like the bridge to understanding the revenue. And 3.8 billion for full year revenue. And Byte detracted 29 million from that. So Byte hurt them. Of course, it's 5% of their business, so they cut out 5%, but hopefully they'll grow their other business units. So 900 million of revenue. So back to your question, international, only 259 million is US. So most of their revenue is outside the US. Like US is US is 29% of their revenue. So that's 71% of their revenue is non-US. Europe is more revenue in Europe. A lot more, because in Q4 2023, Europe had 400 million of revenue, US 368 million. So a little bit more. But now in Q4 2024, revenue went up in Europe, but down in the US, because Byte is a US product. So now revenue in Europe is much higher than US. And then the rest of the world, they have 238 million of revenue, which is down a little bit from last year. I don't know what their biggest country at the rest of the world is. Germany, I think, is a big country for them. Hims, I'm not sure if it's better. I think of him as more of a technology product. They do sell I think they're big on the male enhancement drugs, hair loss. I did the hair loss spray. I didn't like it. And they have hers also, women's products. But I think they're heavy on the people using apps to order through them. They have the you do consultations with a doctor online. I think this company, I don't think is a consumer type company. I don't think you would go to this company and buy products. A dental office would, and a doctor would go to this company and buy products and then sell those products to you. So I think this is more of, I could be wrong, but I'm pretty sure most of their sales would be to businesses, not consumers. Where Hims is a consumer play. I think only like maybe 5% of their business is to commercial companies. So it is a little different animal in that sense. So I think this would be a safer bet than a Hims. But if you're looking to really get a big return, you're probably not going to get it with a stock like this. With a Hims, you could 10x with a Hims. This is not going to 10x. But Hims probably did 10x at one point because AppLovin, yeah, I did AppLovin. Hims was a SPAC. So Hims' low point was $3. Let's just call it 4. So 4 to 50. So from top to bottom, 12x'd. But from top to bottom, it was like 2 years, 3 years. So if you 12x in 2-3 years, that's pretty significant. I mean, this stock, it's 70x'd, but in 20-25 years, which is still a great thing to do, but it's a lot different. I mean, you can make a 10,000x return on a lot of stocks, but if you want to do that with a company like this, you have to wait probably a couple of decades, and unless you time it perfectly. Like Apple's $1 trillion company, but you could have 20,000x your investment if you happen to get in 30 years ago. But in a 2-year time frame, you're probably not gonna. What did I say? Yeah, you're not gonna 15x in a 2-year time frame on a stock, unless you happen to time it perfectly. So let's see if you timed it perfectly in a 2. Let's be fair. So 2022, it's a little less than 3 years. So let's see if there's any 3-year time frame you could have 15x'd. If you bought it in 1990, no, you could have like 5x'd 3 years after IPO. Let's see if you bought it here at 8 in 1999, and 3 years later. Now you could have just doubled it. So that's what I'm saying. Like a company like Hims, the scalability is pretty extreme, but it's volatile. You can lose 80% of your investment on the stock like this pretty quickly, and people did. Let's see, it hit 25 in February 2021, and then it went to 5. So it went down 80% pretty quickly. And then there was a big run up to 50. Unless you got out, actually almost 70. And unless you got out in just 2-3 months, it went from 70 to 27. In 2-3 months, it went down 47%. I mean, this stock probably went down a lot too in a couple months. from 20 to 12. Consider battle videos, X versus Y. In this case, Hims versus X-Ray battle. Yeah, I don't think they're apples to apples kind of company. Like I said, it's pretty different. I would want two consumer-based products to Hims versus another consumer-based product. I mean, sure, they're both in the medical field. But it's like comparing think of another tech company. What's another tech company? Like comparing two tech companies, Apple and Intuit, QuickBooks. They're both tech companies, technology. They both, but it's like it's not it's I don't think it's a fair battle. Yeah, I choose stocks. Yeah, that's a good idea. We can. It'd be good to look at ratios. So it doesn't matter the size of a company, because when you look at ratios, it kind of makes them equal. Who would win? And you could do totally different companies, but it is hard to compare. Like if you compare like a supermarket to a tech company, like you're never going to have a supermarket with high margins. It's but you can compare like maybe a Costco to a supermarket. There's some overlap between those two companies. So, all right, dense play. So everything is regressing. Sales in Europe is going up, which should give you a little comfort. The outlook is 3.5 to 3.6 billion. And their revenue was 4.2 billion in 2021. Then it went to 3.9. This is before Byte. Byte is pretty recent. Then 4, now it's 3.8. So 3.8, which is down like probably 15% from 2021. And they're forecasting 3.5 to 3.6. So they're forecasting another 5-6% drop in revenue. So a company can go down, revenue can go down, and profits can go down, and the stock can still go up because it's just at what price point. It's kind of like if there's $100,000 home that you're interested in, and your friend's interested in a $500,000 home, and even if they're on the same block, there's a home that's 110,000, and there's a home that's 520,000. So your friend is looking at this home that's 520. His price point is 500 based on, the square footage and all that stuff. And the home you're looking at it's 110. So just because a house is 110 doesn't mean it's a great value, because your friend is not looking, this could be 1,000 square foot and your friend is at 3,000 square feet. So just because a home is $100,000 doesn't mean it's a good value, because your friend is not interested. He could afford it, but he doesn't want a house that small. He's looking for 3,000 square feet. And if this $520,000 home, if the price gets reduced to $480K, you're not going to buy it just because it was $500K. I mean, it's a good value, but to you, it's still out of your range. But to your friend, he might pick it up at $480K because it was 500. I mean, his price target is 500, and a house went from 520 to 480. So same thing with a stock. When a stock hits a certain point, I mean, it's not like everybody's going to buy that stock, but if you're looking at it and you're saying, well, it's $13 now, which I think is a good value, but if it hit $9, that's a really good value to me. Then I would buy the stock because a company generating 3.8 billion revenue that has positive free cash flow, you feel $9 stock price, which would equate to, I don't know, 2 billion market cap. You feel that's a good value. So that's just how it is. As a stock price comes down, it gets more and more appealing to investors. And then once it hits a certain point, it doesn't matter if revenue is declining. You just have to have your price point. And then the ultimate situation is you pick up the stock, it was 70, say you pick it up for $10. And if it goes back to 70, you're swimming in it. But even if you pick it up at 10 and it takes a year and a half to get to 20, it's not the end of you're real happy still. So I mean, of course the goal is to 10x your every investment, but that doesn't always happen. But the problem is, even if your investment 10x or 50x's, people don't wait for it to go to that level. Once they're up 30-40%, they sell it. Which is, I think, the biggest mistake most people make is they sell or buy at the wrong time. And no one really knows. That's why buying and holding is really the best strategy. It just takes all the guesswork out. Just ignore the market, ignore the noise. If you think this stock is worth 30 and it's 10, maybe you could sell at 30, but don't sell when it gets to 15. Even if it goes to 15, then it goes back down to below 10. Just give it time. So I like the PowerPoint slides. It does give you a little more info and it's a little easier to read. You could read about their pipeline, their new drugs, and it does give you a lot of financials as well. It usually has many quarters. He has 9 quarters. So you can see revenue is not moving. It's actually at the lowest point in Q4 2024. It's at 900 million. It's never been this low. Probably before 2022, but in the past 2 years, it never got this low. So it could be a really good time. And you don't want to, once a company plateaus, they might, next year we may be doing this video and I'm remember last year was 900 million 2024 revenue, and 2025 revenue maybe 800 million. But you can't wait for the bottom, because investors will not, if it's kind of like when Tesla hit their, started generating 100 billion of revenue. Investor didn't buy the stock when that happened. They bought the stock when they were at 20 billion of revenue and losing money. You can't wait for it to happen, because by that point, it's already gone. You missed all the upside. Same thing with the downside. If a company's profitable, there's going to be a sell-off, maybe when they just start dropping. But once they plateau to the bottom, you can see the stock has come down quite a bit in the last year. And it's not like the revenue it's going down slightly. Only 2 quarters in the past 9 quarters, they had negative free cash flow. And operating cash flow is positive every quarter except 1 quarter. So it's not a risky investment, and it's a 5% dividend yield. So even if the stock is flat, you're getting 5% return. And if the stock goes up and they raise their dividend, that's when you could be doing really well. But is it a value trap? Because you can see the yield, which is the blue line. That's the yield. You can see the yield was low. It's below 1% for many years. And then once it got to 1%, which was 2022, it was staying between 1% and 2% for about a year and a half. Because they're not raising their dividend that much. Every year, it's very little they're raising it. But the only reason it shot up is because the stock came down like 50, 60% in the past year. So the yield went from like 1.5% to 5%. So either two things are going to happen. The company will cut their dividend, or investors will buy the stock and force the price higher, which will bring the yield down to 2-3%. Because if a company can consistently pay a 5% dividend, a lot of people will buy the stock, because there's a lot of people who invest in companies for that yield, and they're happy to get like 3, 4, 5, 6% dividend return. And if a company consistently does it north of 5%, you better believe they're going to get a lot of activity. So what do you think? Do you think the stock price will go up, or do you think they're going to cut their dividend? Well, let's look at the cash flow. Cash flow is coming down, so they may have to cut their dividend. The thing is, they can cover their dividend 2.2 times with their free cash flow, because 280 million of free cash flow, 128 million of dividend payments. So they could. So you can see operating cash flow was $500 million in 2014, and it was averaging about 500 million for many years, but it has come down a lot. They are maintaining their dividend, but in the past they were buying back a lot of stock. So either they were paying a dividend or buying back stock. Now they're not buying back as much stock because they don't have extra cash flow. But I think, obviously, if revenue keeps going down, cash flow will go down. But I think they're kind of plateauing, and I think it could be a good time to buy it. Where does XRAY get its growth from? What do you mean? Where do they sell products to? To their customer base. Let's see if we get a list of their main customers. And it is easier to sell to businesses than consumers. Consumers are very fickle, and you have to do a lot of marketing, and it's hard to get your brand out there. But when you sell to businesses, you don't have to sell to millions and millions of businesses like you do if you sell Starbucks. You have to sell a ton of coffee to a lot of people. But when you sell to businesses, you can usually sell in bulk. Now, what will cause the stock to start going up? Like, what is the growth catalyst? Well, I just think if they continue providing the right products to the right customers, and new products would be something to look into. But yeah, that kind of thing is really hard to identify. But like I said, when you sell to businesses, as long as you continue providing them a good product and service, um, you should be able to maintain your customers and possibly gain new ones through referrals and things like that. But I'm trying to Dentsply. I'm trying to see who their main customers are. It looks like they have like a school where they have 400,000 professionals taking 15,000 courses. It's called Dentsply Academy. So over 4,000 customer representatives support our customers each day. So I'm not sure exactly how this works. I think this just may be a portal where customers can buy their products and also learn how to use their products. I don't think this is an actual school where people go and learn things. Like courses, I think are geared towards what they sell. I'm sure there's some education here, but they do hold a lot of these events. Many, they call them DS events, with like sometimes 10,000 companies go to these events. DS World is immersive experience designed to help guide your practice. It's like a trade show, and they I don't know if they run these trade shows or they're just one of the businesses. DS events. Feels like value trap. What supports that is a value trap. What supports that is not a value trap. I mean, it's your guess as good as mine whether a company where it will move, but I don't see why a company that's been around this long, and it seems like they have a pretty good customer base, why they would continue going down in revenue. I mean, I understand why they went down this past year because one of their products was taken off the shelf and they lost their revenue for that product. But I would think they have the resources to lean into other products. Unless their customer base is just shrinking, which is possible, but yeah, I mean, so they were at 4 billion revenue the past 6-7 years. There was the COVID came down a little bit, but so revenue has been on the flatter side. And these kind of reports will give you a little more insight on new products on the horizon and some stuff in that pipeline. But even with this stuff, like it's so hard to know like what's going to be successful, or even if you were in the industry and are somewhat familiar with these products, it's still really hard. It's like when Apple comes out with a new iPhone, you can say, okay, the new iPhone will lead to greater sales, but I mean, who knows, how it will be perceived, and who knows if it's going to have problems and things like that. It's probably more of a safer bet when a new iPhone comes out because so many people know about it. But when they come out with a new product and they have 10,000 customers, those customers will know about it. Another company or competitor is stealing market share, customer base not spending. Yeah, I mean, I don't know. I mean, I just learned about the company today, and even if I did all the due diligence in the world, there's still some guesswork. Like Buffett does a good job at due diligence, but he's wrong a lot too. That's the thing. Like when you invest, if you're even if you even get 50% right, you're doing amazing. Because say your half your investments go to zero, which is pretty extreme. You just need like those 1 or 2 or 3 ones to 10x, which is wipes out all those zeros. But if, some go up 30%, 40%, some go down 20, 30%, you don't need like you don't have to get like 90% correct in this world. That's why those big investors, you follow them. Some people follow them and say, "Oh, they're stupid." I buy what they buy, and it goes and a lot of the companies didn't do well because they know they don't care if 1 or 2 companies go bankrupt. Sometimes even if you're batting 10%, 1 out of 10, you could be extremely rich, like Masayoshi's son, SoftBank. Just that one investment into Baba, and it was a decent size. It was a big investment for Baba, but only at the time I think it was $20 million. So it wasn't like, even in the late 90s, I think it was actually the mid 90s when they started. Even then, it's not like, oh my God, $20 million. Never heard of an investment that big. But that 20 million turned into 50 billion. So that one investment like took care of pretty much his entire business. Politicians seem to be the only investors that are. That's true. They seem to do well. Okay, I got to go to the store now. Thanks for joining, and let me know about XRAY, if there's any other small cap stocks I should do a video on. Probably talk to you tomorrow. Thanks a lot.